Hey guys, welcome to this week's episode of Investor Intelligence, brought to you by the team at the Property Mentors. It's your weekly podcast for all things, funnily enough, investment. My name is Phoebe Zakowski-Wallace, and back with me again is investment expert extraordinaire Luke Harris, and of course the founder here at TPM. Happy Friday, Luke.
Happy Friday, Phoebe. How are you?
Yes, very good. I think we're both at the end of a very long week, so I think we're both hanging for the weekend.
Always the weekend.
Always. So, Luke, it's time to answer some more frequently asked questions. Today's episode is number 22, but it is our second episode in the FAQ series. Last time, and to kick the series off, I asked Luke to bring 5 questions that he finds himself constantly being asked as someone active in the industry. But this time around, and since some time has passed since that episode, we've had some people submit some questions through our website. So we have a little section on there for anyone to submit that if you want to ask Luke a question that you want discussed in a future episode, you can head to investorintelligence.com.au. But thank you to everyone who has submitted so far. We might even have to do a little a question of the week, Luke. So we should get straight into them.
Absolutely. Get stuck into it.
Okay, fab. So this first one's from Annette. Annette asks, how often should you buy an investment property?
That's a good question. It really is going to be different for everybody. Of course, it does come back to your servicing abilities and how much the lenders will provide, and also how fast you can save or how quickly you can acquire deposits. If you're able to save lots of money, maybe you're running a business or a high income earner with low expenses, you might be able to come up with deposits every 6 months. That's obviously a lot of money. But it does depend on your lending strategy behind that, because of course you need to have the banks putting in most of the money. Predominantly, banks are putting in 80 or 90% of the purchase price. So of course they need to be confident that you're going to continue to service the debt that you're acquiring. And of course, every time you're adding on a new loan, a new property, the banks are going to be assessing your overall situation. So how often you should buy an investment property is probably a good question, but of course, it's going to be more dependent on your financial situation and your ability to buy investment property rather than how often you should buy it. There's no rule or rule of thumb around that. My answer would be every day. If you can buy a property every day, then by all means do that. But it does come back down to your long-term plan. And really, what's the purpose of buying investment property in the first place? If you are trying to achieve a situation where you're replacing your current income, then you may only need to buy 2 or 3 properties to do that. And how often is less relevant to how many and in what time frame. You might need to buy 1 property every 5 years to achieve your goals. You might need to buy 1 every 2 years and only acquire 3 or 4 properties over your investment career. So it really is different for everybody. And it does depend on your long-term goals. That's really the most important thing. Once we know what your goals are, essentially the dreams, the dates, the dollars, once we know the time frame, the amount of money that you need and what we're working towards, we'll work backwards from that, look at your borrowing capacity, what you can afford to buy, and then make sure we have a clear plan of attack in place. So it's more of a question as what fits into your plan rather than how often you should buy.
Yeah, we'll always go back to those 3 Ds. But keeping in mind that this is always general advice only, when done right, is there kind of a reasonable amount of time to establish a portfolio that gives you a solid base for your retirement? Is there kind of a reasonable number across the board or like an average that you see?
It's a very broad sort of question to answer because everyone's situation is different.
Sure.
And of course, everyone's financial situation is different. We've got some of our members that are earning $50,000 a year, and they've got 2 or 3 investment properties that they've built up over the last decade or so. And they might have worked really hard, got their first one, moved out of it, rented it out, saved up even harder, and made sacrifices, bought their second one, and they're onto their third property. So it's not only high income earners that are doing this. At the same time, there are high income earners that are paying a lot of tax, and they've been able to build their property portfolios quickly as well by taking advantage of tax benefits. So to give a guide as to what people need or what they should be doing, it's a very difficult thing to do because one person's situation is entirely different to the next, and we need to factor in not only the income levels, but also the goals. If you're on $50,000 a year and you're looking to replace your income, that's a different situation to somebody that's on $200,000 a year that's trying to replace their income, because often the expenses match the income. So there's a lot of high income earners that we've worked with over the years and currently do work with, and they earn a lot of money, but they spend a lot of money.
Sure.
And we find that often it's people that earn a bit less money, they're actually better at saving.
Right.
And people that have been on good incomes, I've had friends over the years that have worked in the mines and that have had good incomes for 10 years, and they spend it all. They're earning really good income, but they spend everything that they earn. They could have been investing and using that money wisely. And I've got people that I've worked with that that their incomes are less than half of what some of these mining people are. And they save really well. They're very diligent with their money. They know where their money goes. They're not wasteful, and they often get a better result with even half the income.
Yeah. Again, it's always going to come back down to everyone's different circumstances. But I think even as a broad question, the way you've answered that is it still gives it gives people a lot to think about in how to answer that question for themselves. So the second question is from Hamish, and this is to do with buying off the plan. And he says, I'm nervous to buy off the plan because what if my circumstances change? So Luke, I think if we've learned anything in the last 2 years, circumstances do definitely change. But what would you kind of say to that?
Look, I understand it's nervous. People can be nervous buying any property,
Sure.
and you do have nerves and butterflies whenever you're buying any property, really. So I would say that yes, there is sometimes a little bit of extra risk involved with buying off the plan, but of course it comes back down to a long-term strategy. So if that fits into your long-term plan, of course, we've covered your emotional readiness to invest in property, your educational readiness, and of course your financial readiness. So all of these factors have already been discussed, and we make sure that we understand the risks involved. So if your financial situation is a little bit shaky and we don't know, your circumstances might change. If you're planning to start a family, for example, you're going to have kids and go back to one income. If there's a health situation that could affect your circumstances, look, it does happen. People's situations do change. But I think the main thing is to understand how any particular property, whether it's an off-the-plan purchase or whether it's a brand new house of land or an established property, how that property is going to fit into that long-term plan. I know we talk about it quite a lot on this podcast, but the main thing is that people's circumstances change anyway in all situations, and they can and do change. And I think the main thing is to make sure that we have to look at what is the likelihood of your circumstances changing. And the way that we do that is to have a look at what you've been doing for the last 10 years, 5 years, 2 years, and say, look, Phoebe, how long have you been in your current role? How long have you been, doing what you do? What is the risk of you not being able to find other employment? So if you're a chef, for example, I'll just pluck that one out of nowhere, but if you're a chef, and you've been employed as a chef for 10 years, you just need to say, well, what's the longest you've been without work in the last 10 years? And most of the time, we talk to people, and if they've had a relatively stable employment history, the longest I've been out of work was maybe 2 weeks in between jobs. And when we're talking to a lot of people here, especially in Australia, there are a lot of people that have had very short breaks of unemployment where they have another job lined up, and it's essentially a 2-week gap in between jobs. It's not really an unemployed period. There are plenty of people out there that have had extended unemployment periods for 3 months or 6 months or more. But we also need to factor in, if you're employed right now, what is the risk of that happening again? And what industry are you working in? Are you working in an industry that's a high risk industry where there's a lot of jobs being laid off? Or are you an industry that's a relatively safe industry? If you're in an IT position, for example, or if you're in mining, you can usually get other mining work. If you work for a bank, there's often other bank positions. So depending on whatever industry you're in, you've got to look at what's the chances of you actually changing your work situation, because ultimately it comes down to your income more than anything. Your circumstances might change in that, you might have a rough patch in life and things seem a bit tough, but that doesn't necessarily change your financial situation. So our circumstances do change over time, but changing for the worse is generally related to our employment. So what we need to do if we're looking at buying off the plan is factor in the different stages of readiness, understand why we're buying off the plan in the first place, understanding the benefits of doing that, but of course understand what happens if something does happen. What's my plan of attack? What's my exit strategy? Now, some people like the idea of buying something that's 2 or 3 years away because they can get that capital growth in that space of time. They might be in a situation where their circumstances are changing. They may be in the middle of buying another property and they want to pipeline a property for settlement in 2 or 3 years. Or they might be in a situation where they've just changed jobs and they can't get a loan now, but they might get a job they might get a loan in 2 years' time. So a lot of people use that as a strategy to add another property into the portfolio, knowing that they've got something coming down the pipeline. So we know that circumstances are going to change. So it's just how you fit that property into the portfolio and understand how when you put that deposit down, you're entering into an unconditional contract. Some people are going to see that as too risky and they're never going to do it. And we understand that. But there's a lot of people that use that time to their advantage so that they can consolidate their situation, or they can get together some more money and get ready for that settlement.
So as a bit of a comforting thought, all this is kind of taken into consideration, all these risks and all these potentials are kind of taken into consideration before before the members go on that journey?
When working with our mentors, of course, we're covering all of these points and making sure that we've got a really good understanding of your numbers, making sure that you understand your numbers, of course. And when you're having these conversations, you need to make your own decisions as to whether that particular strategy works for you. And really the main thing, as I said, is it comes down to your employment situation. If you lost your job as an accountant, for example, could you go and get another job as an accountant? And I always say this to people as well. If your whole industry shuts down, for example, and you're on $75,000 a year, could you go and get another job in a different industry for $70,000 or $65,000? And oftentimes people say, yeah, absolutely, I could. If I didn't do what I do now, I could do something else. And it means your income doesn't go down from $75,000 down to zero.
Yeah.
It might go down temporarily in between jobs, but then you'll get back up to $65,000 or $70,000 a year. So really, you're not going down from 75 to zero. You might be losing $5,000 a year if you take a different job. But the reality is that often you're still employable and you can find a job. And obviously the unemployment rate's coming down here in Australia, so more people are employed. So that means there are jobs for people. So the risk of not finding a job, you might not find your dream job, but finding a job means that you can continue with your investing.
Yeah, I think that's a really great question to have in there. So thank you, Hamish. So the next one is from Akshara. She says, what is the difference between investing in property instead of saving or investing in stocks? And I guess to reword that even a little bit further, I mean, Luke, why did you choose property over other investment options, or have you ever considered other investment options?
Look, that's a really good question. And a lot of people do, when they're starting out in their investment journey, they're looking at all of their investment opportunities. They're looking at, property, they're looking at the stock market, maybe cryptocurrencies or other things that they could find out there. And a lot of people start Googling, okay, punch into Google, best investments, right? And then all these different things come up. For me, the reason why I love property is for a number of reasons. But to summarize, for me, I live in a property. I understand property. I've got friends that live in properties. Everybody I know seems to live in a property, and that means that there's demand for that particular investment class. Difference to property is obviously you can get a loan for property, you can renovate it, you can subdivide it, you can live in it, you can share house it, you can short stay it, you can put a second story or a third story on top of it, and you can make improvements to that property. So that particular asset class is unique in the fact that food, clothing, and shelter are the basic needs for a human being. And of course, if we're investing in that particular market, we're solving a need for housing and basically using that particular asset class with the help of the banks to give you money to do that. And of course, it's not just the help of the banks, it's the help of the governments that allow the tax benefits and so forth to go with that. So it is an asset class that's like no other, in my view, in that there is a lot of support for property investment from the banks. If the bank's going to put 80 or 90% of the value of that asset up as a loan, and you only have to put 10 or 20% of your own money in, what's that telling you about the underlying asset? Do the lenders in this country see property as high risk or relatively low risk? And obviously, if they're putting 80 or 90% of the money in, chances are they see that as a relatively low risk. Now, they're not saying it's risk-free because you still have to pay that loan back no matter what. But what the banks are essentially saying by the loan-to-value ratios that they are offering, and there's banks out there and lenders out there that will lend up to 95 or even in some circumstances 98 or 100% of the purchase price. It's not a common thing, but what that's saying is that the safety and the relative comfort with lenders out there around Australian residential property is quite high. They're quite comfortable with that as an asset class. Now, obviously, I can't compare the stock market or any other assets to property. But for me, I always ask people the question: if you had $100,000 and you went into the stock market, you could probably buy $100,000 worth of shares. Now, with property, if you walked into the bank with $100,000 and said, "I'd like to get a loan for this particular property," even if it's in the worst street, in the worst suburb, the banks will still lend potentially up to 80 or 90% of the value on that property.
Yeah.
The banks are literally going to give you another $400,000 to go and buy a property for $500,000. Now, so if you've got a $100,000 invested in the stock market and that particular asset goes up 10%, how much have you made? $10,000.
Right.
Now, if you've got $100,000 invested in a property, noting that 80% of that is lent from the bank, if that $500,000 property goes up by 10%, how much have you made?
$50,000.
Yeah, so you've made $50,000. So in one example, you've made $10,000. The other example, you've made $50,000. Now, that's not to suggest that one investment is better than the other, but if you use the example of using the bank's leverage to actually acquire a higher value asset, and that higher value asset goes up in value, then of course you can make money off, what they talk about is OPM, other people's money. Of course, using the bank's money, using leverage can help you to go and do that. And I always ask people, do a comparison for yourself, go into one of the big four banks and ask them how much money they would lend you for their own bank's shares. So go into ANZ, I want to buy some ANZ shares. How much will you lend me to buy your own shares?
Yeah.
And just see what the answer is. And I can imagine that the loan to value ratio on their own shares will be significantly less than what you can get for an Australian residential property. And that means that, and I did this one time, I actually went into a bank and I was actually in there for another reason, but I just said, being a little bit cheeky, I said, I won't tell you which bank it was, but I said, I want to buy some shares and I want to know how much you'll lend me. And they said, we'll lend you up to 50% of the value. So what they're saying is that they see their own shares as more volatile and more risky because they'll only lend half.
Right.
You have to put in the other half. Now, that's just one example. It doesn't mean that that's what all lenders are going to say. Some might lend 80% or 70%. But in that example, they said, we'll lend half. And so what that means to me, my interpretation of that was they were only comfortable to lend 50% of the value on their own shares. Whereas on a residential property, which I already had loans with that particular lender, they had lent me 90%. So what is the difference? Going back to the question, what is the difference between investing in property instead of saving or investing in stocks? Well, ask some questions and you might find out. I think asking questions around the returns, what are the risks, and also what the banks see as a risk. Of course, nothing we're discussing here is financial advice. We're not here to suggest people go and invest in the stock market. We're not here to compare property in the stock market. But when you ask questions around the bank's comfort levels around those assets and what the loan to value ratio is on what they will actually lend, it's something for consideration in that we need to look at the banks and what their loan to value ratios are and what they'll actually lend people for those particular assets. Now, part of that question was investing in property instead of saving. Now, sometimes you need to save to get a deposit together. Now, saving is a really important part, especially when you're starting out, because you need to save that deposit. Often people, they save that deposit, they get $10,000 or $15,000. It's usually after they've been saving for a year or two, and they're up to $15,000 or $20,000. They see the property market going up. They've been saving and making sacrifices, and they just feel burnt out because they feel like they're not going to catch up. They see the property market going up and
tail.
they feel like they're chasing their tail. So what happens is, and I've seen it so many times, I've got friends that went through this a few years back, and they just got to $20,000 and they just gave up. They said, we're sick of saving. We're never going to get into the market. And they went and spent $10,000 on a holiday of that money that they'd worked hard and they'd saved for, and they still don't own a property to this day. I don't know what they did with the other $10,000, none of my business, but they said, look, it's too hard. We're just not going to try anymore. And they're still renting to this day. And look, that's their choice. It's their money. They're able to do that. But with a little bit of accountability, we could have just kept them going just that little bit longer. And it's when people get tired and frustrated of saving that they throw in the towel and essentially, change their plans because it all seems a little bit too hard and it's taking a little bit too long. And, that is really sad to see, especially when people have been saving for 2 years and they're really making some progress. But saving doesn't really get you ahead for the long term. Obviously, with inflation increasing, it means your money in the bank is never going to go up faster than the value of inflation. If you're getting less than 1% on your money in the bank and inflation's running at 3.5%, 4%, then you're losing money. Your money's actually going backwards every single year that your money sits there. So you can never save yourself to wealth. It's not possible to do that. So you need to, at some level, is to go out there and make some investment decisions, talk to your financial planner, talk to your accountant, talk to your advisors about what options you've got available to you. But unless you actually go out there and invest that money, your money in the bank's never going to grow in value to the extent that you could make in other investments. Now, I think one of the things is that on the flip side to that, saving money gives you the ability to lock that away and not spend it. So for a lot of people, that forced saving is actually a really good thing. So instead of having, trying to save over a longer period of time, putting a little bit of money away every now and then, saving 10% of your income and just having that automatically deducted from your pay and going into a separate savings account, it's a really good habit to get into. I was taught that from a really young age.
Yeah,
10% of everything you make, put it away in a savings account, don't ever touch it. Now, that helps you to buy a big ticket item later on. Yeah. And if you've got good money habits, that's where really good investing starts, with good money habits. So saving a small amount of money regularly is much better than trying to find a large amount on a short notice. And it's good to have that for a rainy day, whether it's for investment or other things that can come up in life. It's good to have that regular savings plan in place. And also, of course, the banks like to see a savings plan that you've actually been putting away $50 a week or whatever it might be, and they can see that you're diligent with your money.
Yeah, and to do with savings, we did an episode quite a while ago now, because we've got so many episodes now, but it was called Alternative Investment Strategies. If anyone wants to go back and listen to that, another option to sort of fast forward those saving habits. But basically, bottom line, everything you've said there, proof is in the pudding. Property's not really going anywhere, is what you're saying. Well,
it's not going away. As far as going anywhere, it's certainly going up, and it's certainly doing very well as an investment class, but it's certainly not going away because we all still need a roof over our heads, and just the way that without getting too much into politics, the way the government policies are set up, and we're going into an election now this year in the next few weeks, the government policies really this time around are not touching housing. They've decided to steer clear away from messing with negative gearing and changing all of the rules around property. So they already know that they need to support housing in this country. They know that there's a shortage on housing. If there's a shortage of anything, prices are going to go up. It's very simple supply and demand fundamentals. And if you've bought investment properties, the chances are that over the medium to long term, you're going to make money on that. Unless they start rapidly increasing the supply side of things in Australia, which there's nothing really on the horizon that shows that they're going to, then we're going to be in a deficit for some time to come.
Yeah. So question 4 is from Ryan, and we've touched on this before. I think we've kind of answered it in, with different context each time. It's also, as far as questions surrounding investing goes, one of the most searched on Google, and that is, can I live in my investment property?
Short answer to that is yes, you can, but it then no longer is an investment property.
Right.
It becomes an owner-occupied property at that point. Yeah. So the better question to ask on that is, why would you live in your investment property?
Right.
And really, if you need to live in that property, are there other options for you? So the property is just a building, of course. unless there's a particular emotional attachment to that building or some other reason why you have to live in that property, go and rent the one next door. Keep it as an investment property, and then go and rent the one next door, because living in the investment property is probably going to change your financial situation, and not for the better.
Right.
Definitely need to have that conversation with your accountant first, understanding your tax position before you go and do that, and really making sure that anything that you do as far as moving into a property that was previously rented, making sure that you document that as far as dates and times are concerned. Because obviously there's only a period of time up until the time that property is no longer available for rent that you'll be able to claim any tax benefits and deductions with your accountant. So I would suggest for most people, unless there's an absolute need to live in that property, preference is to keep it as an investment, keep all of the tax benefits, keep your tenant in there, assuming there are tax benefits with that property. And of course, you need to consider, if I absolutely have to live in that property, is it worth moving into that property and losing those possible benefits that I'm receiving? Or am I going to get a better result by renting next door, renting in the same suburb, and just renting myself and essentially rent vesting and keeping that property, tenanted as it previously was?
Yeah, great question. But basically, it's important to talk to your team and your accountant to determine what the impacts of that will be for you.
Absolutely.
Yeah. Now, for the last question, so this one wasn't actually submitted through the website. However, so in addition to Luke, our mentors here are also first-hand hearing questions day in, day out. So I'm always interested to hear what questions keep popping up in those conversations so that we can share them here to our listeners as well. And this week, the wonderful Malika brought one forward that she's been hearing quite a lot lately. And that is, I'm curious about how equity works. I actually don't think we've spoken a lot about equity yet, and how that can be used to help you get your next investment property.
Okay, that's a really good question. Equity, to explain first of all, equity is essentially the part of the property that you own.
Yeah.
The rest of it, the bank owns.
Sure.
So if let's say, for example, in the example that we used before, where the bank is lending 80% and you've got 20% deposit, the 20% money that you're putting in is essentially your 20% is equity in the property. Now, let's say it's a $500,000 property, and you've put $100,000 in, which is 20%, 80% of the bank's money, which is $400,000. If that property goes up by 10% in value from $500,000 to $550,000, that extra $50,000 is extra equity in that property. So your original $100,000 is still in the property because you've used it for your deposit and so forth. But the extra growth in that property, when it goes up in value from $500 to $550, that extra $50,000 is equity in that property. So if you sold the property, you'd get your original equity, and you would also get that increased value, the capital gain in the purchase price to its current value. And obviously, the longer you keep a property, ideally, the value should increase. So if you keep that property for 10 years, 12 years, it might go up from $500,000 to $900,000, maybe $1 million, maybe more. And the gap between what you paid for the property and the current value is the equity in that property. And of course, essentially, if you look at the value, take away what you owe to the bank, that's the equity position.
I think that's a really great explanation, because if you Google what equity is, there's not a lot of simple, easy to follow descriptions there. So thank you for that.
Yeah, it can be. It's easier sometimes to draw it down on a piece of paper, because you can highlight this is how much the bank owns and this is the part that you own. And people get a bit of a shock now, but it's my property. Why does the bank own so much?
Right.
Well, they've put the money in, right? The other part to that question was, how can you use that equity to get your next investment property? Obviously, we did an interview with Chelsea a little while ago and explained the finance side of things. One of the first things to do is to obviously get an understanding of the value of your property or your property portfolio. If you've got more than one property, get an understanding of the value of those properties. For everybody that's taking their investing seriously, and everybody on the call here today should be, you should have a spreadsheet with all of your properties listed. Even if you've only got one property, have your property on there with all of your expenses, council rates, insurance, any taxes you've got to pay. All of these things have to be listed on there, and they get all of your loan payments on there as well. So we know how much money you're actually putting into that property, but also get an understanding of the value of the property. And you can do some very quick searches on realestate.com and on Domain. There's other tools online where you can get a growth history of the value of the property. And most people that have investment properties, every now and then they'll jump online and look at what else is selling in the suburb. And I know what I was like in my early 20s, and I had 3 or 4 properties, and I was jumping online, oh, this one sold for this price, and this one sold for this price, and that means my assets going up in value. So I'd always check on my spreadsheet and update them every time there was a similar sale in the area for a higher price. I'd say, well, this one I've gone up by another 30% or another 15%, and just updated my spreadsheet. So I always knew what my total value of my portfolio was, but also knew how much I owe the banks, which showed me my equity position. And so when I went to my mortgage broker, I was able to say, hey, this one's gone up in value. Can we now access that equity? And so this is what you want to do as an investor. Again, fitting into a long-term plan is to go through and discuss with your mortgage broker, again, with your accountant, making sure that you understand your numbers and discuss the options for using that equity. Now, often people will see ads on TV for equity. There was one a while ago, a bank was talking about, equity, mate. That was the ad. Everybody was talking about equity, mate, where people were seeing the values of their properties rise. Banks knew this, so they targeted people with this equity mate ad to tell people that they could pull their equity out. The values of their asset had gone up, so there was equity in their properties. So banks knew this, so they advertised specifically targeting people that had equity so that they could talk about refinancing that loan. And what that means is if you let's say we go back to the original example where $500,000 property, the bank has $400,000 invested, you've got $100,000 invested. And let's say you've had that property for 10 years, it's now worth $1 million, just for round numbers, okay?
Sure.
$1 million, that means that your original $100,000 plus $500,000 of increased equity. Okay, so that property now has, with your original capital, has $600,000 of available equity in it. So if you sold the property, you'd get $600,000 cash minus any other selling expenses.
Right.
So what that means is when you originally bought it, they lent you 80% of the value. So assuming that the bank will lend, again, we're talking a very generic scenario here, but if the property's worth $1 million and they will lend you 80% of that value, that means you can borrow up to $800,000. Again, they still want to see 20% left in there. So $1 million value, 80% is $800,000. Your original loan with them is $400,000. So what the banks will do is they will lend you up to $800,000, meaning that you could pull out that extra $400,000. That extra $400,000, what could you do with that?
Oh, potentially put that towards another property.
You could put it towards another property. You could go and invest in the stock market. You could invest in cryptocurrencies, and depending on the lender, you could even use it to buy a new car. You could use it to do renovations on your home. You could put a pool in. There's lots of things that you can use your equity for. But the lenders in the last few years have started to really tighten up on what you can use that for. They often want to know if you're pulling out $400,000 from your equity, even if it's $50,000 or $100,000, they want to know what you want it for. And if you just say, well, I'd like to have it there for a rainy day, sometimes the banks don't accept that. If you explain to the banks that you're pulling that out for future investing, then of course they're more open to that because they know there's a specific purpose for that. The best thing to do when you're looking at using your equity is to talk to your advisors, talk to your mortgage broker, talk to your tax accountant so they get an understanding of what you're trying to achieve, and also make sure that it's structured the right way because there's different ways of pulling out equity. You may need to set up that particular equity release as a separate loan within your master loan. Because if you're going to use that for personal expenses, you need to separate that from your business, which is essentially your property investing. So again, all of these conversations are on an individual basis. We're not giving specific advice on that today, but make sure that you're having these conversations so that before you go in and refinance or try and extract some equity to go and buy some more investment properties, is to make sure that you've got the structure right first. Talk to your accountant, talk to your mortgage broker, talk to your property mentor as well, so that the property that you select fits in with that long-term plan and that you're not over leveraging yourself, which means you're taking on too much debt. And of course, your accountant and mortgage broker will pull you up on that first. If the banks aren't going to lend you the money, they will tell you straight away. There's no point in applying for a loan if you're not going to get approved anyway. So it makes sense sometimes to tap into that equity if you've got a good use for it. And of course, if it fits into your long-term plan.
Well, thank you for clearing that up, because again, Google is not always a great way to get that answer. It's really nice to actually hear someone talk about it with examples and actual numbers. So well done of that. I think that is going to clear up that answer for all of Malika's members who she's been talking to.
Yeah. Okay. Google does have some good information sometimes, but I think the biggest problem with information out there, and we are in the information age, of course, and everything's available on an instant's notice, is that there is a lot of information out there, but it's often conflicting. And you can get something that you read on Google or read on the internet somewhere, and it conflicts with something that you read 5 minutes ago. So this is what we do really well, is to really teach people how to critically analyze the information that you're getting access to and apply it to your own situation. And I think that's the thing that's missing with a lot of people, is they're getting a lot of information, but there's so much information. How do I actually process it all? How do I understand it all, and what's right and what's not right, and what's really applicable to my own situation? Because there's so much information that you'll end up reading, but it may not be applicable to you, or it may not just be applicable to you now. It might be in 2 years or 3 years' time, but right now you need other information. So it's knowing how to process that. And of course, you know, as a property investor, treating it like a business rather than as a hobby. And when you treat it like a business, you're going to lean on your advisors. You're going to lean on your financial planner, your accountant, your solicitor, your mortgage broker, your quantity surveyor, your property manager, and of course your property mentor to help pull it all together. So really, these things are it's a journey to go on, and understand that, you know, there's going to be a lot to learn along the way. But again, you've got professional advisors out there for a reason. They can help you to interpret the information that you're reading.
Yeah, the good news is there's no shortage of information. The bad news is there's no shortage of information, basically.
Exactly right. Exactly right.
Well, they are the frequently asked questions that we have for today. Thank you so much to everyone who did submit them. As I mentioned at the start of the episode, if you have any questions that you want to know and that we didn't cover today, you can now head to the Investor Intelligence website to submit them, and we will make sure to include them in an upcoming episode. So you can find a link to that in our show notes. As always, if you would like to know more about us here at The Property Mentors, you can check out our website, thepropertymentors.com.au. Make sure to also follow us on Instagram. There's the Investor Intelligence podcast and The Property Mentors Instagrams. Again, links are all in our show notes. If you're ready to take your investing knowledge to the next level and want to get your hands on Luke's latest book, Property Fit, you can visit propertyfitbook.com.au. Thank you so much to those who have subscribed, shared, and left a rating. We really, really appreciate that, because again, it just helps us reach more people on their investing journeys. And if you haven't subscribed, please do, because it lets you know when the episodes drop. As always, thank you so much for listening. I will be back in your ears again next week. And Luke, as always, of course, thank you.
Thanks, Phoebe. Appreciate your time, and lots of good questions there. We look forward to getting a whole another series for our next episode.
Most definitely. Investor Intelligence provides general information only. You should consider seeking independent advice to see how this information relates to your unique circumstances. Please refer to the terms and conditions available at investorintelligence.com.au for more.